Hey guys, John deRoulet, Head of Revenue Management Education here at Wheelhouse, and I'm here to talk to you about a data deep dive for Oregon and Washington Coast. Really excited to look into some of this data with you guys. We're going to kind of explore what is going on from an occupancy perspective, a little bit about pace, and talk a little bit about strategy and what people are doing. We're heading into summer, so we felt like this would be a great time to talk about this. Before I get started, I did want to just bring up something small, but Wheelhouse is now offering all of our performance insights for free. This includes the market data that I'll be using. It includes more neighborhood specific market data that you'll have access to. And most importantly, it includes our business intelligence platform that shows you pacing and year over year historical. So I'm going to be talking a lot about pace. I'm going to be talking a lot about expectations. If you don't have a way to visualize this in your portfolio, reach out to Wheelhouse or sign up for free. You get access to this, and we'd love to offer you some training and talk to you about how to do it. All right, let's jump into some data. So I have here 4 market reports for different market areas in Oregon and Washington along the coast. I'm going to be primarily using the Wheelhouse Market Report, which can be found up here in the upper right. This is a high-level kind of analysis. You can see that these zones are pretty big. It's a little bit larger than kind of what we do with our pricing model. But it gives us a good idea of kind of what's going on at a top level, and we can use it to kind of get an idea of how we might expect the summer to be coming together. This data is free, so you can access this without being a Wheelhouse pricing customer. All you have to do is create an account and log in, and you can search and find these market reports for any country across the world, really. The 4 market areas I have are what we're calling Lincoln County, which is really this kind of Tillamook and south along the coast area. I have Seaside, Oregon, so Seaside on the Oregon side. You can see that does include a little bit to the east, but really these numbers are very, very small. The majority of these listings are here along the coast. I also have the market report for the Seaside, Washington area. This is going to be a much smaller market area. There's a lot less inventory on the Washington side. And so we'll just take a look at it. I do have it open. And then I also have the market we're calling Aberdeen, which is the coastal area just north on the Washington side. We're going to go ahead and start with Lincoln County, so Tillamook and south, because this is going to be the much larger market area. And the first place I'm going to go is I'm going to hop over to our trends section. So this trends section is going to show us occupancies month over month and year over year. It's a great way for us just to kind of see how things are trending this year and really just give us an idea of kind of what's going on. So first thing I'm going to do is I'm going to click off 2023. I don't need to look at that right now. And we're really just going to compare 2024 and 2025. I'll click off 2026 too. So you can see here that, beginning of the year, January was looking pretty good. Interestingly, that's something we see consistently across the country, that January started off really strong. But this is a low season, as it is for any non-ski market, generally a low season. So even though it's a little better, most people were going to be vacant. So you may or may not have seen that in your portfolio, but we do see a little bit more market occupancy at the first of the year. Once we get into February, we start to see a little attrition. Again, though, this is going to be a low season, so many people probably won't notice, or you don't have, it'll be hard to notice because there just is so much vacancy. It's kind of almost a crapshoot for what gets booked. But that little bit of attrition in occupancy is going to continue all the way pretty much through May. So coming out of the low season into these shoulders, we do see a little bit of a bump over spring break, March, April, May, but all of those are coming in a little short year over year. So a little bit of pressure, but honestly, not a ton. So if you're sitting here wondering, like, well, maybe you're seeing a little bit of vacancy in your market, maybe you're, wondering how summer's going to be. In these Northwest markets, you don't have a ton of time to really see big changes. When you look at markets in the South and stuff like this, they have some spring time periods that can be really strong, and that really tells them what to expect for the summer. Up here, it's going to be very weather dependent. It's going to be very, drive in, potentially last minute. So it's hard to get an idea if this pacing is going to follow up in summer. And really, kind of like the New England markets, you have to make most of your money here in July and August and June, and potentially a little bit in the fall. As you can see here, even though spring has a little bit of bump as a shoulder, that fall, that kind of Indian summer, is going to be a stronger time period than the spring. Now, May is where we start to see kind of the early shift into potentially a higher season. Going into June, you can see that this builds up, and this is falling short a little bit more than it had in the past. So March fell short a little bit. Easter moved. That Easter did not make up for itself in April, but it stayed pretty close. Looking at looking at May, though, we're almost done with the month right now, and we're starting to fall a little bit shorter. So really the question becomes, is that going to show up for June, July, and August? One of the quick kind of rule of thumbs that I like to use when I'm kind of looking at pace is if you're using some other pacing tools, you can sometimes just see it. But for the sake of just using this kind of free market report, I'm going to take a look at this. So you can see here that we're a little over 50% of the way to where we were last year for June, right? So we can see that we're pacing, we're about a little over 50% currently. And in July, we're about 33% of the way. So 25% is about a third of 76. Now, if I go over here to the historical daily data, we have these distribution charts. And if I go down to the lead time, I can select June, and we can just get an idea where the 50% mark was for June. So 50% was about 50 to 55 days last year. So that's when the market was at 50% till the end of the month. And if we go to July, 33% on the books was about here at 80 to 85 days away. So let's piece this together. Right now, for June, we're 50% of the way there, and we are about 35 days till the end of June. So pretty short. Last year, the market was at 50% occupancy 50 days in advance. So you can see that we're trailing a little bit. Almost 2 weeks worth of pickup, well, really almost close to 3 weeks worth of pickup in terms of trailing. So that pace is looking a little bit weak for that early summer booking. When we do July, we're at about 33%, and we're 65 days till the end of the month. Last year, we were at that the market was at that 33% occupancy rate about 80 days in advance. So you can see overall that the market at the top level, aggregate level, is trailing quite a bit in terms of the pace. Now, if you tuned into the revenue management roundtable we held in the third week of May, we did have Joe, who is in the Seaside area, and he mentioned something quite similar. The early pacing is a little bit weaker. They're seeing that they really need to make adjustments almost twice as far out as they had in the past, but they are seeing very, very strong response in the short-term window. Now, that means that likely rates are going to be much lower if people are seeing that response in the short-term window. And for you as a revenue manager, it means you know the market's pacing behind. You have to take into account how you're pacing. If you're pacing well, that's going to change it, considering if that's going to change what you do compared to if you're pacing behind. But overall, if that pacing is going well or poorly, you need to make a decision about how far out you want to go, because you know that the market is pacing behind, and you're probably going to see, one, a lot of bookings in the short term, but also a lot of rate changes, and you want to mitigate how much that's going to affect your own ADRs. Now, I'm going to go over to this other piece here, asking rate, because I just like to check what the rate positions look like in the market. So asking rates are the averages of what people are advertising in the market. And I think it's a good thing to compare in the future to occupancy. So we know the occupancy is pacing behind. We can also see that at the market level, when we look out at May, June, and July, the market in general is still pushing a higher rate than it did last year. So there's probably a lot of room for you. Now, what is causing things? I don't know. If the higher rate is causing consumers to not book, if consumers are just waiting till it's shorter season, we also know there's a lot going on macro level that could cause people to change their buying behavior. But the short takeaway here is that the market is still pushing the rate above what it did last year, and the market's pacing behind. That means as a revenue manager, you have choices depending on how you're pacing, especially if you're pacing a little behind or you're concerned that things are maybe going to get a little chaotic in the short term. What you can do is, you know that there's room between where prices are now and what the market did last year. There's a lot of space there. And if everyone's still priced a little bit high, and they're pacing behind, you can probably expect that they'll drop the rate. It means that if you make those adjustments before them and stay under them, you potentially can take more market share of what's booking now. In addition to that, if you are also pricing your stuff well above what you kind of actualized at on average last year, that is a really good thing to check. We see, like, coming out of COVID, that was a standard practice for people to kind of keep premiums high and push the rate. The last 2 years across the country, as we've seen more pressure on occupancy, a lot of the top revenue managers, we're hearing them say, build a base of business, start more conservative and build up your rate as you see demand, as you see yourself pacing on track or ahead. That's the opportunity to take advantage of ADR. But what you want to do is try to avoid having to compete with everyone in the short term and potentially watch your rate position collapse because you're behind pace now. Now, there's one other thing that I like to look at. I just like to take a quick glance at what the top performing listings in the market are doing, just to see if there's a little bit different trend. If I click this to high, we're going to look at top 10 to 15 to 20% of listings, and you can see here that the primary difference, the overall trend is pretty similar, right? January is still a little higher, a little bit of attrition from February through May. The primary difference here is June and July's pace. June in particular is a little bit more than 50% of what it's like 5/8, so about 62%, so probably pacing much closer to last year. Interesting to note, though, is July is about the same. So they have a lot more occupancy on the books in those top listings last year, but they're still only about a third of the way, which means July is pacing even in the top performing listings. And for, we're starting to run out of time for July. We're going to be within a month and you're going to have to start making adjustments. But what that means is that there's potentially going to be a much bigger impact on rates in July because that pacing falling behind is applying to every segment of the business, whereas in June, it's really not applying to some people. Some people have started to pace on track or ahead. Okay. The next one I want to look at is Seaside, and just kind of see, I imagine because we're looking across the coast, we're probably going to see pretty similar trends, but let's just take a look and see if we see anything substantially different. Pulling up Seaside's occupancy trends, we can see pretty similar thing. January, a little bit better. February through May, a little bit of attrition coming through, so losing a little bit of ground on the occupancy perspective. Now, it is important to note that June appears to be pacing much better in Seaside than it was across the rest of the coast south of Seaside. They're at about around 60% occupancy instead of that 50%. And for July, they're at about 42% of what they did last year. Now, if we go check these booking windows, because again, these might be a little different, I'm going to go to the historical, I'm going to go to this distribution section, and we're going to hit lead time. If we go to June, we can see at about 35 days, 35 to 40 days, that there was about 70% on the books. So while we're still seeing Seaside trail a little bit in that last year it was at 70% occupancy by this point at the market level, this year it's at 60%. It's not trailing near as much as Tillamook and the rest of the southern coast. Now looking at July, I'm going to find that point. So we're about 65 days away. And you can see at about 65 days, the market was at 47%. So July's pacing in Seaside is actually very close. So last year, there was 47% occupancy on the books. This year, about 42%. So while there is some slight pacing trailing, it's not on track to be a big problem the way that it might be south of Seaside. In fact, it's probably on track to be very close, at least if things stay consistent, to kind of how things have been, where the market is seeing a little bit of attrition. May is seeing a little bit more. June, July may look a little bit more like May. June actually seems to be pacing worse than July, but the July pace right now seems to be pretty decent. Now, if we just take a look at the highest performing listings, there's a few differences here. One, really, these are the July is actually pacing much better in the high performing listings. It's almost 50% of the way there, so it's actually pacing ahead of last year, while June looks about the same. And then the only real difference here is that Easter drove a lot more in the top performing listings. You can see that April actually performed a little better than March did, whereas at the market level, April saw a little bit of a loss. So you do see that these high performing listings are taking a little bit more of the market share when the market occupancy is under pressure. They also are booking further out and earlier. And that's kind of a good indicator. Like, obviously, if the properties are just much better, there's not much you can do about that other than improve your advertising, really cover your reviews. But it also does mean, it does indicate that there are people booking further out. So if you're pacing behind, especially for July, you know that the market's a little behind, but not that much behind. And it may mean that you need to adjust your price to really get those guests in the door, because they are booking. That pace in July is pretty close to what it was last year. And in the highest performing, it's actually ahead. Now let's just take a look at the rate positions real quick. The main thing I want to focus here is on May, June, July, and August. You do still see that at the market level, even though each of these months is trailing a little bit behind, the rate position is still a little bit higher. Now, when we compare that to the rate positions in Tillamook and South, that rate position is not that much higher. So the market is being much more conservative to what it did last year, and those pacing situations seem to be better. So if you're south of Seaside, you really want to maybe take a look, because the market is pushing rates a little bit high. We know that people are booking early because we can see it in Seaside. They do have pretty good pacing, and it may just be a matter of the rates being too high for the consumer right now. And if you make some adjustments, you might be able to correct any pacing problems you have, or really just take a much bigger market share. If you're in this area, it's really going to come down to how you're pacing. If you're pacing behind, the market itself is pretty similar to what it was last year. You need to make sure that you're in line with that. And honestly, if you need to catch up, you may need to undercut it a little bit. This market is not going hog wild on pushing rates, and you can see that in the pacing. Now, let's just take one quick look at the highest performing group, just to see if there's any significant differences. There's really not. You see that the rates are pushing a little bit, even in July and August, where July in particular, where the prices are still growing year over year, but also pacing ahead. So it doesn't seem like this market is too overpriced for its consumer. There just seems to be a little bit less occupancy coming into the market, and it really is going to come down to how you're pacing. If you're pacing or having any pacing issues, you might need to get really, really competitive with the rate, and you probably don't want to wait to the last minute, because we did see that there is a little bit behind pace. And if you're competing in the short term, it may be more difficult for you. Okay, so for these last two, I'm just going to take a quick look at the trends, because I imagine these are going to look pretty similar. So when we look at the Seaside, Washington kind of portion, just a little north of Seaside, you can see a pretty similar trend here. Decent Q1, a little bit of attrition. The pacing looks a little bit rough here. We're actually under 50%. So if you're north, I would really pay attention to your pacing. If you're not on track, you may need to make some substantial adjustments, because this market is pacing kind of poorly. Now, interestingly, June is barely pacing ahead of July here. July looks to be about on pace with the other markets that we've seen in terms of being about 30% of the way there, but June is under 50%. It's very, very low. It may be time to make some adjustments for June. If we look at the asking rates for these, you see much bigger increases over the summer. May, things have been pretty similar, but these increases do not appear to be resulting in a positive kind of environment for the market. The market is having some trouble pacing, especially in June, maybe into July too, and you can see that the market itself is probably overpriced. So really something to pay attention to, unlike Seaside on the Oregon side, where it's very, very competitive. The pacing is pretty good. Just north of the border, you're not quite seeing the same thing, and you're seeing a much bigger difference in terms of prices being much higher than they were historically. And then for our final look, we'll take a look at Ocean Shores, Washington. This is going to be a much bigger market area than the Washington side of Seaside, which is a very small kind of market area designation. And when we look at the trends here, what we see is something pretty similar. Now, there's a few interesting differences here. One is that April drove much better occupancy compared to some of the other markets we've looked at. In fact, it's almost at last year's occupancy. However, it looks like March suffered quite a bit more. So a little bit more volatility in the spring. May looks like it's going to fall short again, and probably, but interestingly, not quite as big of a margin as March. So March really suffered in Ocean Shores. And then when we look at the summer, we're seeing a pretty there's a much bigger July and August here than we've seen in the other ones. June tends to build up a little better. We're still a little less than 50% in June, so that pacing seems a little bit weak to me. And when we look at what's going on in July, we're a little less than a third of the way to July. So it's actually the worst July pacing we've seen. And this kind of concerns me that we're actually seeing very little difference between June and July in overall position. We would expect for this high season that had started booking. And, we're coming to almost within a month of these July dates. It's really time to start making the adjustments you need. Now, interestingly, August is actually the highest season here. And we're seeing a little bit on the books here. It's going to be really key. And there is plenty of time to make adjustments for August. So if you're seeing weakness in your pacing for June and July, don't just stop at making changes for June and July. Start thinking out into August, because that's going to be really important for you to be able to get the top ADRs possible and make sure you're on pace. You really need to be more than 30 days out. Just to kind of drill that home, I have July pulled up on our lead time distribution here. I'm going to go to that 65-day mark. And at 65 days, the market was at about 50% of what it was going to put on the books. So 50% of 70%, because it made 70% last year, that's about 35%. So you can see that the market is trailing almost a third of what it did last year. This is a big red flag, I think. This market's pacing looks a little bit, Ocean Shores looks like it's struggling much more than some of the other markets we've looked at. You really need to check your own pacing and see if that's the case, because if you are also pacing behind, you should probably make these changes now, because hoping that the short-term window is going to be good is a risky hope, and you can make it better by putting on a base of business now. At the end of the day, you're going to end up cutting the prices in the last minute. So you might as well make some cuts now and see if you can get higher ADRs than what you're going to get at the very last minute. Quick glance at the price. You see a similar trend here to what we saw on the Washington Ocean Shore, or the Washington Seaside stuff. The pacing for July and June is not very good, and the market is keeping rates significantly higher year over year. And so, one, if you're looking at this, it means you have a lot of opportunity to take market share. You may not need to go all the way down to last year's price, or you may not need to undercut last year's price, because you have a lot of room to be competitive with the market, since the market in general is pricing so much higher than everybody else. This includes August, and I would really advise that you look at August, because Ocean Shores has such a strong August. But it seems like the market here is not really that well optimized to the consumer. The consumer is not buying this the way that they need to, and it's about time for the RMs in this market to take advantage of the market being overpriced and try to take as much market share as they can now for June, July, and August.